Hi, I'm Howard Wall, Director of the Hammond Institute for Free Enterprise at Lindenwood University, and welcome to Free Exchange, your gluten-free TV alternative. And today we're talking with Rachel Douchant and I, who is the Director of the Liberty and Ethics Center. We'll be discussing the role of government and versus markets in things like the recent financial crisis and the recovery or the failure of recovery afterwards.
Absolutely.
So Rachel, your purpose on the show here is this is a confessional for me.
Okay.
Because I've, as you know, worked at the Federal Reserve for many years.
Yes.
Prior to joining Lindenwood, and the Fed is partially or largely responsible, depending on who you speak to, for the financial crisis and the crash, and for the mess that we're in. Now, so I was involved in that. I knew what was going on, but I have not been absolved yet of my sins.
Oh, do I have the power to absolve you? That's an interesting question.
You're the one who serves as a confessional.
Okay, all right, I hear you.
So I'm giving testimony.
I hear you. Well, the first thing we need to talk about is the crisis itself as an example of government failure. So most people are going to think of the crisis as an example of market failure, right? Where did we go wrong?
Right. It was just like with the Great Depression. There were people claiming that this proves that the market doesn't work. The market is prone to these crashes, and that may or may not be true. But this was not what happened. This was a classic case of government mismanagement and misregulation, and setting up incentives for the financial system to crash. And people say, oh, it's the greed of Wall Street. And it's fine, let's accept that bankers and Wall Street, they're greedy, but they've always been greedy. You have to accept that they're always greedy. They always want every penny in your pocket. Let's accept that.
Yeah.
Did they suddenly become more greedy in 2003, 2004, and so on? No, they did not. So if you want to look at the cause of the financial crisis, the crash, and then what led up to it, you have to look at what other things happened for that greed to take hold or to have an effect on the rest of the economy. So where do you lay the blame? How do you assign it? Well, there are a couple of things going on in the background that were kind of long-term policies, or policies not really directly related to financial markets, but were affecting the housing market. And the housing market is really the driving force behind the financial crisis. Sure, the bubble. And since 1977, banks have been required by law to give out more loans, more risky loans than they otherwise would, the Community Reinvestment Act. And the idea was to force banks to serve underserved communities. So they would relax their lending standards to promote home ownership among the poor and minorities and so on. And gradually the requirements for that were ramped up and kept getting higher and higher. Now, that alone would not have caused the financial crisis, although there were some bad incentives set up. But the other thing going on is the Fed was still fighting the previous recession by keeping interest rates artificially low, the recession of 2001, and interest rates were kept low for a very long time, longer than they should have been. And the mortgage market was being pumped up because of low mortgage rates. So those two things are going on. Quickly, just for novices, why does the Fed lower interest rates? Well, the idea is lower interest rates mean that consumers and firms can borrow at cheaper rates, so they'll invest. Or for consumers, they'll buy things, so this will boost the economy. We're supposed to be sort of pumping it up by encouraging people with low interest rates. Right, and there was a jobless recovery after the last recession, so the Fed kept the interest rates very artificially low for a long time. Okay. So those things were going on, and those are normal things. Also going on was the housing market has been, the mortgage market has been propped up by Fannie Mae and Freddie Mac, these two quasi-governmental entities, where they're private entities, whereas if they make profits, the profit is all private. It goes to the shareholders. And if they make losses, then it's backed up by the federal government, by taxpayers. So they don't have to bear any of their own risk. So they don't bear any risk. There's this implicit bailout, which turned out to be an explicit bailout in the end. And they're encouraged to prop up the mortgage market. Now they're supposedly regulated, and they are regulated by various laws and by a regulatory agency, and Congress sees that. But that's where it comes in, where it all came to a boil, is that Congress failed in its responsibilities to regulate those entities in particular. And so subprime mortgages were a huge problem, which led up to the financial crisis. Subprime mortgages are mortgages given to people who otherwise wouldn't ordinarily get mortgages. They're not prime risks, they're subprime risks. Yeah. And in 2003, and I have a chart, but I don't want to torture anyone with my charts. In September 23rd of 2003, there were hearings in Congress about whether to rein in Fannie Mae and Freddie Mac so that they're, to change their regulation. And the House and the Senate refused to do this, and it was bipartisan because the relevant committees were basically bought by the financial community.
Gotcha.
So
you've got some cronyism going on there.
Pretty straightforward.
Yeah.
But more particularly, the head of the House Banking Committee, Barney Frank from Massachusetts, said that he wants Fannie and Freddie to roll the dice a bit more. Okay, at the time that he said that, the percentage of mortgages that were subprime was about 2.5–3% of mortgages. Within 5 months, it was about 13 to 14% of new mortgages were subprime, and it was just a dramatic shot upwards in subprime mortgages directly as a response to the Congress giving a green light to Fannie and Freddie to buy up all sorts of bad mortgages that are out there.
Yeah, and one of the things that has become clear to me as we've discussed the crisis is that it's not just Fannie and Freddie shuffling off the risk to the government, but everyone else selling their bad mortgages to Fannie and Freddie. So everyone is shuffling off
so
their
now
risk.
what happens is you have a local broker giving you a mortgage, you meaning someone, a subprime person, someone else.
Not me, I'm prime.
And then the broker immediately sells the mortgage off to a bank, and the bank either carves it up into mortgage-backed securities or whatever, but eventually Fannie and Freddie end up owning subprime mortgages. So by the time of the financial crash, Fannie Mae and Freddie Mac owned 74% of all subprime mortgages in the United States. So they were clearly the source of the problem, was that they were sucking in all of these subprime mortgages.
And why isn't there somebody there saying, this isn't sustainable? Right? Oh, look what's happening. There's been this sudden shift. We need to pay attention to the long-term consequences of these choices. Can you explain that to me?
There's not really much money in that, is there?
So just perverse incentives all the way down.
Well, it's absolute ignorance of basic economics on the part of some people who are in charge of regulating. Certainly very selfish political and financial motives by people in elected office.
And you can pat yourself on the back and say to your constituents, I'm getting people into homes or something like that, right? And you don't have to explain where the risk is going to go. Can these people pay their mortgages?
Well, you can always blame it on the greedy bankers.
That's good point.
And then bail out the greedy bankers.
Yeah.
So when people say that the financial crisis was a failure of the free market system and they need more regulation, the banking system is the most regulated industry we have. Yeah. Short of perhaps medical, but not then. Probably the banking sector was the most regulated sector we had. And not only was it a failure of regulators, it was also, in different cases, the problem was promoted directly by regulators because regulators were captured and they were using their power of regulation to push their own political and sometimes financial benefits.
Explain the term captured quickly.
So capture is, you can have an industry that's regulated and that industry now has the incentive to influence the regulators or to choose its own regulators.
Of course.
So,
and you can toggle back and forth between the private sector and the public sector.
Yes, it's a revolving door between Wall Street and the Treasury Department.
So we regulate ourselves.
And the various regulatory agencies.
It's interesting to me when I talk to people who tend to be, let's say, less skeptical about regulation than myself. It's almost as though just having regulation is what they want. And there's not a question about, well, what regulations, right? It's just having regulations doesn't necessarily mean that you're limiting these people in a good way.
I had conversations with people after the financial crisis, and then they were rewriting. By the way, it was Dodd and Frank. Dodd-Frank is the financial new financial regulations where that was the same Frank that got us into this mess. And
was this supposed to be his atonement, or was this just
no? It was certainly not
just
his
a trick.
He was befuddled by the question. He was asked, "Do you bear any responsibility for the financial crisis?" And he was, "What? how on earth could you even imagine that I had anything to do with it? I've always been a champion.
Yeah.
No idea.
Wow. Wow.
About how regulation works and so on. So it was just a complete disaster. And then they're put in charge. And basically what they did is they created more regulation, that's for sure.
Right.
So I would have a conversation with people, don't we need more regulation? I said, well, I don't know if we need more regulation. We certainly need better regulation.
Yeah.
More, you could just force banks to fill out 1,000 forms every time they
right, that doesn't make
make a loan. That's a lot of regulation, but that's not very good regulation.
Yeah.
So it's not more regulation, you need better regulation. And then the regulation that came out, more likely than not, will end up leading to a greater risk of financial crashes. And instead of having banks being too big to fail, where you're not sure whether or not they're going to be bailed out, like we did bail them out, now they're sure up front that they're going to be bailed out.
Right. So now they really will take the risks.
It does remove some uncertainty from the market.
Right.
So I guess that is a benefit. So it's a complete disaster.
Yeah.
Up and down on the government regulatory front.
And is that why it sets us up for another crash? Because they know they're going to be bailed out, so they'll take risks that they would never normally take?
Yeah, so banks now, I remember the problem was the reason we bailed out banks was that they were too big to fail. So they fail, and this brings down the whole system. Mm-hmm. Now, with all of the regulations they favor large banks who have the wherewithal, the resources to fill out the forms for regulation and deal with regulation. So now the banking sector is even more concentrated in large banks.
Right.
And
less competitive.
Some of the entities that used to be non-bank entities like Goldman Sachs and Merrill Lynch are now entities that we know will be bailed out.
Right.
Before, they had no notion of being bailed out. They did not have deposit insurance, anything like that. But now they know pretty sure that they're going to be bailed out.
Will you tell me about the phrase "too big to fail"? What is your position on that? Right? I mean, do you just let these people fail? Would that have been better, or what would you have done?
Well, the too big to fail part of it was actually, I think, partially the only good policy that was that came out of all of this, and it's the one that's the most reviled. And we'll talk about that. You can straighten out the befuddled look on your face.
Okay, all right. I want to hear it.
So we're going to come back. This is Free Exchange with Howard Wall, Director of the Institute for Free Enterprise at Lindenwood University.
Can you help me with this? My new dad teaches me all kinds of stuff.
Sure.
He helps me with homework.
That would be 3.6795.
Thanks.
Yep.
He helps me with my decision making.
I wouldn't use this one. Ever.
And he's even teaching me how to drive.
And that's why cars have bumpers.
I'm learning so much.
You don't have to be perfect to be a perfect parent. Thousands of kids in foster care will take you just as you are.
Time to wake up.
I've got a job to do today.
I've got a job to do today.
Don't forget, you've got a job to do today.
Hey, Mom. I got the job. Thanks.
I've got the job.
Welcome aboard.
Have a good first day at work, Mom.
Your donations to Goodwill fund job training programs right in your community.
Feels good to start fresh, right?
Sure does.
And like that, you're a job creator.
What do you think it would be like to teach? Chances are, you have no idea. Teachers today are breaking down obstacles, finding innovative ways to instill old lessons, proving that greatness can be found in everyday places, and that you don't need to be famous to be unforgettable. That's what it's like to teach.
Hi, welcome back to Free Exchange. As always, locally sourced and emissions-free. We're talking about the financial crisis and whether or not the government was to blame or the free market was to blame. And you had a look of befuddlement.
Well, you said there was one good, did you say regulation that came out of this?
Action.
Action of the government, but one that's the most reviled. What's that?
So the one that is the most reviled, it's a shorthand for all that's bad about the bailout, is TARP, which stands for Targeted Asset Relief Program.
Okay.
And then there are other associated things that went with it.
Right.
And the idea behind this was that the government put aside several $100 billion. I lose track of zeros when it comes to this. It was really a lot of zeros.
Yes.
So this money was set aside to help financial market players like banks and others to prop themselves up, and then other programs to support different markets, different submarkets in the economy, and the government bought up different assets and so on.
And the idea is that if they didn't, it would sort of crumble the whole system, that you'd have one would go down and it's such a big, important piece that everyone else wouldn't be able to
Right, so
adjust.
It was very large banks and financial firms were at risk of completely collapsing, and various markets had frozen up.
Right.
And the idea was you can't let this happen so these banks are too big to fail.
Right.
Because allowing them to fail means the entire economy would freeze up because the financial market freeze up. And then you would have the whole country, plummeting into recession. So TARP, which was not executed quite the way I would have done it myself, actually was good intention, and is actually what the Fed is there for, is to provide liquidity during financial distress, to lend money out and to prop up markets when they're collapsing in crises. So TARP was meant as a crisis moderator, and in that sense it worked. It moderated the immediate financial crisis and kind of kept things going, because we kind of saw what happened when Lehman Brothers went bust and so on. But then it kind of dragged on a bit, and then they used TARP money to bail out auto unions and so on.
Right,
right. And the fact that it did work showed that there was extra money left over, because the financial system, the confidence in the financial system was restored. They knew it was going to, and then there was extra money left over, and then of course they blew that on.
Well, I remember
even
in Thomas Sowell's book, Basic Economics, he talks about Keynes versus the Keynesians, right? And the idea that Keynes himself has this sort of notion that you want to kind of settle, make sure that things don't completely fall apart. But you immediately pay all of that off, all of that debt off, and you don't let it go on. And what you're describing is exactly the trap that the Keynesians seem to have fallen into, which is that it just snowballs and becomes like mission creep.
Yeah, so it became a slush fund, really.
Right.
Hundreds of billions of dollars in slush fund.
Yeah.
And then they did some really bad policies out of it. And TARP was generally a success in achieving its goal, but they did some really horrible things, like not giving a financial haircut to very many of the players who should have borne some of the cost. Of their own decisions, but they were bailed out 100%.
Yeah, we'll keep you afloat, but we're not going to bail you out 100%.
Right, but
that's what we did.
They got every penny out of a dollar that they put into it, and that's the part that was.
There's a little Austrian economist voice in the back of my mind here that wants to ask you a question, which is, when we bail these people out, even if we were to do so in a smart way, which it's hard to do because everything's so corrupt, but even if we were able to do that, are we just putting off the inevitable? I mean, in other words, is there some sense in which the system has become so dysfunctional that you need to just allow these things to fail? And it's going to be painful, but otherwise you just get basically the situation we're in now, where we haven't really learned anything.
Well, the argument for things being too big to fail, it should be unique to the financial system, because the financial system is the backbone for much of what the rest of the economy goes on.
Yeah, it's sort of like the blood.
And you can argue whether that's a good thing or a bad thing, but it became applied to other industries where it was completely inappropriate. So the TARP money was used to bail out General Motors and Chrysler, and those were not bailouts of the auto industry, those were bailouts of the auto unions, the auto workers. Because they completely perverted the order by which debtors and shareholders are paid in order to finance those things. And there's this notion unlike a financial firm, if a financial firm loses money and declares bankruptcy, it's because it has no money. And then it's done. But with a real firm that actually produces things, that's not what happens.
Sure.
Going into bankruptcy means that you get your debts rescheduled and renegotiated. But you still exist. Airlines go into bankruptcy all the time, and then they come out of bankruptcy.
Right.
And it's a way to shed really bad contracts,
and
which is
people
why
do.
they didn't want General Motors and Chrysler to go into bankruptcy, because then all of their union contracts would have been thrown out and renegotiated. That's why it was a bailout of the auto unions, which was unnecessary for the existence of the firms. It was clearly to save the union contracts. Had nothing to do with actually
So that's really
protecting
another
the
piece of
industry.
cronyism there.
Yeah.
So I want to ask you a question about something that Alan Greenspan said, which absolutely shocked me, because I have seen his letter on the wall of the Mises Institute praising them for their work, and I know he was a kind of a Randian, an Ayn Rand guy, and he said, "I guess I was wrong. Markets don't work the way that they're, that we've said that they work, and I had the wrong philosophy." And I thought that's the lesson he's taken out of the 2008 crisis. Now, what you've told us is an account that contradicts that. So why would a guy like Alan Greenspan say that?
Well, I think it's Alan Greenspan, and then some of the other architects of financial policy and economic policy before and after the crisis are denying that they were wrong. Greenspan is saying he was wrong, but it was because everyone was wrong. It was
our whole
not
philosophy was wrong.
Yeah, it was not that he was personally incompetent. Because you can look at economics, free market economics, and he was not practicing free market economics.
That's right.
He was practicing interventionism. He was practicing lowering interest rate, manipulating financial markets by lowering interest rates to boost the economy.
Right.
So his alternative is to say that he is personally incompetent. And instead he says, I guess it's just markets. Markets don't, it's the market's problem. It's the economy's problem. And this is a strain of thought among those who are responsible for the situation we're in now. Lawrence Summers, who was the architect of the President Obama stimulus plan, and he'd said this will bring unemployment down within a year to low levels, this will work great, and said, these things, we bounce back fast from deep recession, so this will be great, no problem. And that didn't work at all. Instead, we're still going on for years afterwards. His new thing is that there's something called secular decline. It wasn't him. It wasn't the policies that are the problem. Obviously, the policies were perfect. It's the economy is the problem. The economy changed suddenly for no reason.
People just weren't as interested
We've done
in
the right
producing
policies,
things.
so in fact, we've done a great job. This is as good as it gets. And we've brought the economy back to where it should be, because this is as good as it gets. It's the economy that's failing us. It's not the policymakers. And you see this within the Federal Reserve also, where they don't look at themselves and say, geez, maybe keeping interest rates close to zero for so long was a bad idea. It's just the economy. The economy has really changed on us. Shame on the economy for not behaving as it ought to. But it's more of, I say it's a psychiatric problem because these people need help because they can't admit that they're incompetent. And having worked at the Fed, I can tell you that there's a lot of well-meaning, perhaps, but certainly overly confident in their own competence.
And then everyone kind of passes the buck when it all goes wrong.
Yeah, and then again, they still can't admit that they didn't know what they were doing.
So talk to us about the recovery and how you might have done that differently if you'd been in charge.
Well, so I was actually not in charge, but I was at the Fed, and I'll tell you what I said at the Fed at the time. I said that, so in early 2009, so the financial crisis is over, and now the economy has to, pick itself up, get moving. New president is installed, and I had said that President Obama is extremely lucky because even if he does nothing, the economy will just bounce back on its own and have a very strong recovery, and he can take credit for it. He'll be easily elected. The problem was that he did not do nothing.
That's right.
He did a lot of something, and that something was clearly the opposite about what should have been done.
Yeah.
He had a stimulus that was never going to be stimulating. Even if you believe that you can stimulate the economy with fiscal policy, he did it all exactly the wrong way by pouring hundreds of billions of dollars into things that people didn't want. subsidizing state and local governments, preventing them from getting their own fiscal house in order, green projects that are just diverting resources in the economy. And that's the opposite what you want to do. If you want to stimulate, you immediately get money into people's hands so that they can spend it, and then things happen.
Right.
And that may not have worked anyway, but we don't know. Because everything was done the wrong way.
We do have a couple of examples, right, of recessions where people did sort of do nothing, and there was a quick bounce back.
Yeah, in the 20s, there was a recession that they did nothing and things bounced back quite quickly. And you find that when there's overly meddlesome intervention, this delays recovery. The Great Depression is a classic case. There are actually several recessions during the Great Depression, and often preceded by new and really stupid government policies.
Right.
And the other thing I was saying, and this is more to do with Fed policy, is I'd said, all right, the crisis is over. Now we get interest rates back up, not to where they were, but instead of 0, say 2.5%, get back to something normal. Let's do, and then deal with it. But the notion is that it's not the level of the interest rate, it's that if we do things, this does, it's the action that we take. Whether or not we take action influences things, not the level of interest rates and so on. You have the right look on your face, which is, that sounds incredibly stupid, and that's exactly the look you should have.
Okay, I see what you mean.
But they've kept interest rates close to 0 for years and years, and seems to have escaped them that when you distort price signals so much, that this might cause misallocations in the economy, like having a stock market bubble, and so on, that maybe it wasn't such a good idea.
Yeah.
And the problem is that it's not economics is the fault, it's that these people are very bad economists.
Okay.
They don't take to heart the first lessons of economics, that prices send signals. There's information in these prices.
It's simple.
And be very careful when you meddle with prices. Better to have a good reason to do it.
Yeah.
And if you meddle too much, you're going to completely distort the signal that prices are sending, and the economy can, maybe be in extended recession and really bad recovery for years to come.
Right. And so our unemployment levels today still reflect not a great...
Well, there's another thing. Actually, the unemployment rate is falling, but that's mostly because people have been bailing and giving up on the labor markets. But there's an excuse for that, too. That, again, is not because of the policies.
It's secular decline.
It's secular decline and demographic change that suddenly occurred.
Yeah, people just don't want to work.
Suddenly, more people have decided that they don't want to work. And it's just a coincidence that it coincided with the collapse of the economy.
Yeah.
So like I said, it's psychiatric problems, not policy problems.
I appreciate your point about the journalists, grabbing onto those numbers and getting very excited about unemployment going down, but not really appreciating what the real situation on the ground is.
Right.
Yeah.
Oh, sorry, we're out of time. We're going to have to finish this conversation some other time. And thank you for joining us. This has been Free Exchange from the Hammond Institute for Free Enterprise at Lindenwood University.